Welcome back to Good Returns. I'm Matt here with Garrett, and the scoreboard says 4 consecutive positive weeks, 2 all-time highs in a row for the S&P 500 and the NASDAQ, which is doing some interesting things today as well, and a market that by most measures is in a good place.
Yep, and you look beneath the surface a little bit, and the picture gets a little more complicated. Oil, we got back above 100. Peace talks canceled. Treasury yields reversing. Next week brings a Fed meeting and a cluster of major tech earnings that could set the tone for the next month.
Yeah, good week on the scoreboard, a week that raises some questions going forward. We have a lot to get into. Let's get it.
And as always, everything on Good Returns is for educational purposes only. Nothing we say is personalized financial advice for your situation. We are here to give you context, help you think more clearly, and feel grounded when and if you decide to sit down with a professional.
All right, let's get it. How did stock market do this week?
Well, like you said, we have the 4th consecutive positive week. The S&P 500 and the NASDAQ both closed at fresh all-time highs for the second week in a row. And on paper, an incredibly strong headline.
Yeah, it is. I did notice the pace of the rally slowed a little bit as we approached the end of the week. Today, some mixed market is still open as we're recording. Some mixed results. NASDAQ's doing great. Intel, like that came out of nowhere, really. That's really driving the tech stocks. Intel just blew their earnings out of the water to the upside.
Earnings season. Happy earnings season.
Yeah, so kind of today is a little bit of a snapshot of kind of what we've been experiencing, some uneven gains. We did have small cap stocks actually outperform the major indices this week, which again, we always underscore is a very healthy sign when that happens and the continuation of that happening. It does suggest the rally is broadening, very important word there, rather than being carried entirely by the largest names. That's been a theme we've been talking about since January. International stocks, on the other hand, did trade lower as prices rebounded and the dollar strengthened. So value it was modest, but very important. Again, the theme we even through all of these world events that are occurring, liquidity issues in certain pockets of the market, the AI expansion, CapEx, AI fears, we are still seeing that trend of value outperforming and small caps outperforming. And this week was no different. It was a modest outperformance of growth, but still, nonetheless. So all that being said, S&P hit a new high, 5 of the 11. I know some people consider there to be 12 sectors. We won't debate that 11 or 12, but 5 out of the there's at least 11, right? Sectors traded lower, so we had the majority trading higher. Defensive sectors, oddly enough, lagged, which is interesting. I know there was some interesting aspects to the Boeing earnings report, secured some pretty significant contracts, so that helped that particular company, but defense writ large, and that just may have been, kind of the market pricing in, maybe we've hit peak defense spending, at least in the short term. But, we'll see. Defense is always hard. That's always a hard one. It doesn't necessarily go exactly the way that you think it would. And they've gotten so large that 2 or 3% movements, yeah, that's nice. But a lot of these companies have become so large. So I think that it will be interesting to see some of the private companies that are looking to IPO, some of the defense players, one in particular, Palmer Luckey or Lucky Palmer.
Anduril.
Anduril, yeah, that are smaller. It's going to be interesting
Palmer
to see
Luckey is his name.
Yeah, Lucky Palmer,
Could go
Palmer
either
Lucky.
Way. Either name it
rolls off
nice.
the tongue. So it'd be interesting to see when those players get in. But yeah, defense has been lagging, which is, you wouldn't think, right? That would be the case with the amount of munitions needing to be replenished and different changes going on with just technology in general in the defense space. But it's very interesting.
Yeah, I'll add the international stocks trading lower was really, we saw that in developed international. We didn't see that in emerging markets so much. Emerging markets kind of stayed elevated, but interesting nonetheless to see the divergence between the two. And developed international fell like really significantly. Like it fell pretty good. We track it, every week we look at that data. And so I'm like knee deep in a project right now where we're trying to rebuild one of the systems we use. And I'm got a lot more, I'm looking at the data a lot more than we normally would. And I'm seeing that happen like in real time where the developed international drops way down, and I'm having to go back in to other sources and like confirm that. Like, it was so strange last week that happened. When it showed up in the data that I was kind of developing, I guess we're trying to write our own program to a certain extent, but I had to double check that. I was like, wow, that looks really odd. And I went and double checked it and it actually was correct. So that is an interesting kind of split there between the developed and the internet and the emerging markets. But to go back to what you're talking about, it is a distinguishing factor there. When you have new all-time highs where more than half the sectors are declining, it's a narrower advance than the headline maybe suggests. It kind of tells you the market is digesting recent gains rather than pressing aggressively higher. Potentially.
I mean, you did have volatility measured by the VIX, the VIX, ticked higher a little bit, but as we spoke about last week, we talked about credit spreads. Another aspect of credit spreads. When it say that
really
5 times
struggling
fast.
This morning.
Yeah.
Every time I get on this microphone, my throat like closes up or something. It knows I'm on the podcast.
Yeah, I know. Your body is like, I have to perform. I have to do this, and
I don't know what it is.
You're choking. You're choking, literally, I guess.
Yeah.
All right. No.
I'll try to keep it to a minimum.
So the VIX ticked a little higher. Credit spreads, which we spoke about last week and the importance of it. We looked at high yield credit spreads, which is going to be the difference between and if you remember last week, we spoke about the difference between corporate bonds and government bonds. So high yield spreads are the difference between your like AAA, very strong established company corporate bonds and your smaller company corporate bonds, your higher yield. They were pretty flat. Kind of mirroring what was occurring between government debt and corporate debt in general, which is a good sign. Both of those aspects are consistent with a market kind of pausing rather than pulling back. So that really underscores, again, the theme here. The rally is intact, even though this week you did see a slowing of the momentum, so to speak.
Yeah, and on the bond side, yields drift higher despite bonds finishing the week with modest gains. The 2-year Treasury, which we've talked about a lot, gave back nearly half of the 3-week decline that had been built on ceasefire optimism in the falling oil prices. And reason for that is kind of directly related to our big story this week, which we'll get into in just a few minutes.
Yeah, absolutely. Oil did tick up a little bit on the week. You had Brent crude, which generally trades higher than what's called WTI, which is West Texas. Ooh, is it intermediate? I believe
we'll go with that.
Yeah, West Texas Intermediate. I believe that's what it is. Correct me if I'm wrong in the comments, but do it nicely, please. Markets moved higher. Excuse me, that I've gotten ahead of myself here. But so yes, you had Brent crude climbed back above 100. WTI is a little less than that. So the past 2 weeks have been really on the decline. This week we did see an edge up, really all being driven by bets and gambles and speculation on the outcome of different geopolitical events. So we'll see how that plays out.
Yeah, kind of brings us to the theme of the week. We'll move into that. Markets on the scoreboard moving higher, but underlying forces which have been driving the story in the headlines that we've talked about, conflict, the Strait, Hormuz, the oil supply question, they didn't really resolve. They kind of shifted. So we'll talk a little bit about that. Yeah,
when we speak about headlines driving markets, which they have been known to and generally will drive market movements in the very, very short term, which again, as a long-term investor, is why you don't really want to pay attention to them, because short-term decision-making always robs you of generational wealth. It's just a rule of the universe. But we will start with the headline that really drove a lot of this week's market movement. There was a ceasefire that was extended over in Iran. On its face, looks like a meaningful step forward. But in diplomatic terms, everybody, it doesn't really know, right? I mean, you can tell that with the market, with the short-term moves that are occurring. Will this result in a meaningful cessation of hostilities? What will it bring about? And that's really, I think, the headline that drove both the ups and then the compression, how quickly the market was going up as we got towards the end of the week. It's very interesting to observe.
Yeah, we've been watching this pattern for a couple of weeks now, where you have a diplomatic signal which is constructive and a physical reality which doesn't sort of match that. And so you're seeing this much the same thing. Naval blockade of Iranian ports remains in place. Scheduled peace talks are being canceled. Questions emerged this week about potential leadership change in Iran. So that adds a whole new layer of uncertainty around even who's coming to the table.
Yeah, ceasefire being extended, blockade is still there. From what I can tell from independent sources, the point of the blockade, which has kind of been, from my understanding, in the playbook in the Pentagon for quite some time, it's really always been, going back into the 90s, you had a few options. Karg Island, which is where 90% of Iranian oil gets processed through for shipment out, is the Achilles heel, or the strait itself is the Achilles heel. So you kind of see that playbook, again, just the best that I can tell from just, reading independent analysis on the situation. So, I'm not sure any of the short-term market moves really have a true handle on how long that blockade will or will not last. And the end goal is that the longer that it lasts, the greater the oil supply disruption is going to be from Iran. Because what happens in the oil and gas industry, and again, correct me if I'm wrong in the comments, is when you have these wells producing and pumping, that oil, it's not like you can just turn the faucet off and then turn it back on when you want. It's like a blood supply. It has to keep going or the organs die. And so if the longer the blockade lasts, and this may be why you're seeing different competing reports coming out from the leadership tussles that are going on in that particular country, in the longer that blockade lasts, you run out of space, and within days from where we're recording today, you run out of space to store that oil. And when you run out of space to store that oil starts going the other direction, and you have to stop the wellhead. And when you do that, you cannot easily get it back turned on, and you may never can actually get that well to produce again. So a new well has to be drilled. So when you're looking at the oil supply disruption, the longer the blockade lasts, the greater the disruption will be from the Iranian oil producers, which by and large is not that much considered what comes out of the strait. It's really the UAE, Saudi Arabia that produce significant volumes of the oil. But I think that it's very interesting, and this is a slight deviation from the show notes, but I think, again, it underscores what, my thesis, the framework that I've approached all of this from, which is that every single day that goes by, the world is, and the world's GDP is less dependent on the price of oil every day that ticks by, because you're looking at what could be a potential major oil producer potentially being offline for 10 to 30 years. And you compound that with what has happened to the Russians' oil infrastructure, which is, it is an understatement to call it significant. It is mind-bogglingly bad what has happened to their oil infrastructure, as far as from their perspective, right? From the Ukrainians' perspective, it's absolutely wonderful what's occurred. But when you look at the significant, long-running, multi-decade supply disruption that's taking place currently in Russia and quite possibly in Iran, again, we can't break 120 a barrel. You can't break it. You can't force the price of oil over 120. And now where Brent has been hitting 100, WTI still in the low to mid 90s. I don't know. It's going to be very interesting when we look back 3 or 4 years from now to just see, this in fact could very well be the last oil-driven market disruption that modern economies have ever, quite possibly.
Yeah. I think you have two different stories, which is kind of how it affects everyone else that's not us, and then how it affects us. And so when you are like living through that and you're paying more for gas or whatever it is, I think it's harder to be a longer term thinker in those kind of scenarios when you're like, man, I just got hit with a huge gas increase. Got to drive to work. I've got to drive whatever. It doesn't really, like you've said before, it doesn't stop the consumption of it. You still have to use it. But it kind of has, an interesting effect on on your psychological way of thinking about that, especially as an investor and then as just somebody going to work.
Yeah.
And
I would just encourage you. I mean, again, if most people are going to be just like us, we're living life. We have our work time, we have our family time. We're just doing, if we're going to go on vacation, we're going to go. Groceries, the price is what they are. You can marginally try to change it, but hey, you got to buy groceries, you got to buy gas, et cetera, et cetera.
Mm-hmm.
But yeah, I mean, I would just challenge, if you're interested, simply go to Google. You can use the Google AI feature as a deep dive, or go to, ChatGPT or Grok, and then, ask it about the per unit contribution that oil has to GDP in developed economies, and look at that the way it was 40 years ago, and look at what it is today, and it's quite. It starts making you understand a little bit more. With all of this stuff going on, how is the price of oil so low compared to what you would think it would be, right? And it's an interesting kind of educational journey to go down, to just really see how dynamic the economies of the world, including the Chinese economy, is when it comes to these. We have all been insulating ourselves from these impacts over multiple generations, and it seems to be working. I saw somewhere the other day that the Chinese have significantly more oil in reserves now than we do, as far as strategic reserve pumped out of the ground and stored or purchased from others. They don't really have very much oil on land. But just kind of the bank that they've been building over the past decade. So it's very interesting. But the market does seem to be pricing in the probability that the diplomatic track does win here. That's if you're trying to read the tea leaves from the price action, where people are putting their money where their mouth is in the market. That appears to be the track that we're on. And that, again, could be a reason why we're at all-time highs, even with oil getting uncomfortably high for people, right?
Yeah, that is a very interesting thing, because I think Monday pre-market, people were kind of expecting it to take another dive based on what happened over the weekend, with negotiations kind of stalling and then the Strait being kind of open a little bit and then closed again. I think everybody was kind of bracing for something that didn't really materialize. And so that is a very interesting way to look at it. It's like, all of this stuff going on and all the uncertainty, it's not having the effect that it would have had 3 weeks ago. I mean, there is something out there that is, the market sentiment, I guess you would say, has kind of flipped a little bit, and they are looking more positively into. There are more positive areas to look at than there were 3-4 weeks ago, and that's a good sign. And it, will continue to get that way based on earnings and things that come in, Federal Reserve decisions, as we'll talk about later. But, it'll be interesting to see them actually work toward a resolution. I think everybody wants that to happen.
Oh yeah, especially market participants. When you're investing for the long term, and you're disciplined, and you're contributing to your 401k, and you do, even though and you're psychologically prepared for short-term disruptions, and the resiliency of the market is so incredibly strong. Everybody loves certainty. Everybody loves certainty because it takes pressure off your mind for you to think about other things.
Unless, this is an interesting thing, you like certainty in the markets, unless you are, well, I guess it is certainty from the same. But I was going to say, like an example we might run into in the midterms, where you have divided government. That's sort of some uncertainty, but the markets really like that uncertainty.
Oh yeah, yeah. It all depends on your framework, and then whether you're from an institutional perspective, whether you're a bond investor or an equity investor, your certainties are much different.
Right.
Right. But people do like certainty, and there's nothing wrong with that. And that's one thing that we bring to the table with our clients, is a certain level of certainty. In order to, plan for the future, watch that plan become successful over time, and enjoy the fruits of your labor. So I almost made it through another 20 minutes without tripping over my words. But let's look at the oil reversing. It's a downward trend, kind of coming up a little bit. What can we expect?
Trying to figure out what it's at right now.
I think it's like 96. depending.
The way I usually look at this is not working for some reason.
But let's look at what can we help our listeners kind of expect to see headline-wise as we get near the next Fed meeting and the new chairman that's coming in. Let's assume that oil is stagnant at kind of about where it's at after going up around 5% last week with Brent crude. Brent crude I know is over 100. As far as WTI, I want to say it's like 95, 94. So what can we expect, and what have we seen maybe in the bond market, which really affects interest rates? What have we kind of seen with the short-term kind of knee-jerk reaction to that price, that move back to 100?
The most of the things that you're going to see are bond market related. So we talked about the 2-year Treasury yield giving back nearly half of the 3-week decline. So when you have, again, we talk about this a lot in this podcast, and I feel like we're like beating a dead horse at this point, but the conversation is around oil rising and that giving the Federal Reserve potentially an excuse to, I don't know that I would say raise rates, but it gives them an excuse to like put the blame on future inflation and kind of halt and not do anything.
Yeah, and the key there would be not oil up, inflation up. It would be, because I think that I've pretty much ended that thought experiment pretty precisely about 3 weeks ago, just with the historical data. But if you look at oil up, it's not inflation up, but it's oil up, inflation worries up.
Because of future inflation,
Yeah, the worry there.
Right.
Yeah.
But that's the only thing they have to go off of. The Federal Reserve has a dual mandate, which we know, which is price stability and employment.
But I thought that they used core CPI, which stripped out the volatile food and energy pricing.
Yeah, I mean, this is the problem. If you're at the Federal Reserve, this is the problem. This is the question, and we have a new Federal Reserve chairman coming in. He's through.
Oh, that's this week. Has it already started? The confirmation.
Yeah, the confirmation's already started. Yeah, so he's in the process of that right now. But historically, you would see oil up, that would give the Federal Reserve a reason to pause. Oil down is the opposite effect, meaning the inflation worries are largely not there, and they can go about cutting rates again. But I'd be interested to hear what Powell says. He's going to speak next week, he's going to speak next week. And we'd be interested to see what he says, particularly about kind of forecasting, what his comments are in relation to that.
Yeah. I mean, my view hasn't changed. It really,
we know,
like I could put noise canceling headphones on and blindfold myself for the next 3 weeks, and I'm still have a pretty high degree of confidence I'm going to be right. Rates are heading lower.
I think there's a lot of people that agree with you, but the end result is that the conversation, that typically is how it works. There's no, this is not a new regime that's coming in. This is how it has historically worked. When you have a big spike in oil, you expect that there will be the ripples through the economy will lead to some sort of inflation. But again, it's all in time frame. So if it's
also considering the fact that because the U.S. is now a net exporter of oil, an argument could be made that the higher the prices go, the greater the economy grows, which is a new paradigm because that has not been the case. We really have not been a strong net export, ever until I think 23.
Yeah, I mean, it's recent.
22, 23, something of that nature. I believe it was in the post-COVID era, I think. But even if it wasn't, I mean, a few years difference. But the simple fact is that it's all an illusion, honestly, the back and forth as it pertains to what will or will not cause inflation. Because if their assessments were correct, then we never would have had the run up in inflation if they knew, right? So it's all about maintaining credibility, which is important. I'm not saying it's not. We operate with a central bank.
Do you think the Federal Reserve has a similar amount of credibility as it's always had?
I think so. Oh yeah. And I think that the steep increase, which is as a percentage gain, was the highest ever since the central bank was created in 1913, when they hiked.
Raised or hiked. I'll translate for you.
When they hiked interest rates starting at the end of 2022. And that was all about credibility. That's what that was about. I still hold the belief that their assertion that it was transitory was correct. I think their timing was wrong. I think that it was transitory inflation. It was demand driven, and but regardless of all that, it was all about credibility. And so that's why you have a lot of this language that's injected and creates this short-term uncertainty, is because they constantly want to maintain their credibility, because you have to have credibility. If you're going to have a fiat-based system with a central bank, the central bank has to have credibility. So I'm not saying that's a negative thing, but rates will be heading lower. Warsh has been very clear about that. And that is his name, Warsh. I'm not saying wash with an accent, right?
There's like two different ways to view that, though. I mean, you're viewing it from purely like an academic standpoint, where you're looking at cause and effect, and you're looking down the line at, like you talk about, second, third order effects. But there's also the reality of, like, it does cost you more to fill up your gas tank now. It does cost you more for airline tickets. It does cost you more for all of these things that are being directly affected by these prices increasing. Mm-hmm. So that's like the real world type of inflation.
Okay, so what happens though, if you spend double...
Get some more water for this conversation.
I need your full attention here. Let's wait until we get this. We get some ASMR going on here with pouring the...
I'm out. All right, go ahead.
We got to have fun on. I mean, it's Friday.
This is water. So everybody knows.
I don't know. It's supposed to be sparkling, right?
No.
Oh, okay. I was about to say, I'm not seeing bubbles. No. I don't know. So if you are spending more on gas, more on plane tickets, more on travel, do you have more or less money at the end of the month to buy something else?
You have less.
You have less. So what happens to those items that you're not buying? Do their prices go up or do their prices go down?
I mean, that depends.
Right?
It depends on what it is.
It's the same concept with, and this is why inflation is not privately created. It is not created in the stock market. For instance, today, it's for people buying Intel shares. It now costs them more money to buy Intel shares than it did yesterday. Is that inflation? No, it's not. Simply because something costs more does not necessarily mean that it's inflation. Inflation is the debasement of the money supply. That generally does not come from the private industry. That comes from government and overspending and deficit spending. That's really the source of inflation. And so when you have a tax that goes up, you're paying more to taxes, for instance, you have less money to spend on something else, that is not inflationary. This is what we spoke about last year as it pertains to whether or not tariffs would or would not be inflationary. Now, tariffs are a tax. It's costing more money to buy those items. And never in the history of ever has a tax been inflationary, because it reduces your purchasing power, meaning you have less money to spend. So you cannot, by demand, push up prices. Now, you can by supply push up prices if supply contracts. That's what we saw during COVID. So it's the dynamic is much more subtle and nuanced than one would think, and it is very much less on the nose than what the media and the headlines would lead you to believe. Again, if you're spending more for gas, you have less money to buy something else. So that CPI, that core CPI index that excludes the volatile energy and food, is not going to go up because people cannot buy more of it. They can buy less. Now, when you take that, which this is all short term and to an extent hypothetical, because there's so many variables and moving parts into our economy that I could very well be wrong in my assessment because of that. But from the potential new Fed chair's perspective, the biggest driver of deflation or a structural disinflationary economy is artificial intelligence and the productivity being driven by artificial intelligence. And I believe that that is happening right now. And I think that he, as other Fed chairmen in the past, Alan Greenspan is what I'm thinking of, if they are right on the movement of productivity, then the central bank can be a tailwind to the economy and the market, and not just a mechanism for controlling the animal spirits within the economy.
Do you think they have been so far?
No, I don't think so. I think because the credibility issue, which again,
I was about to say, doesn't that lead directly into the credibility issue?
Yeah, I think that the previous Fed that took us through COVID, and I think that
the current Fed,
yes, that's right, that took us through the COVID era. I think they did. I remember sitting in our Monroe, Louisiana office during that time period, and I believe you were in the Columbus office when we had this conversation, because I remember it, and I said, "Wow." Within like 48 hours, the Federal Reserve has done what took them like a year to do during the 2008 financial crisis. I mean, they were very proactive. So I'm not naive enough to think that one can judge all the moves and decisions they made, Monday morning, quarterback it and say was right or wrong. But I think that the credibility issue when it appeared that the market called their bluff on the transitionary inflation during that time period, that they decided that their credibility was needed to be front and center, and that they would do whatever it took to bring down the rate of inflation, the rate of change of inflation. And again, that could have been the history will tell that could have been the absolute right thing to do. But I think if you're thinking forward and you're doing like Greenspan did he saw productivity gains through the dot-com era, and it appears that AI is going to be an order of magnitude greater than that, then we as market participants are looking at a pretty nice setup for economic expansion, economic growth. But we'll see, things change, and this is a large entity with hundreds and hundreds of extremely intelligent economists that do have different perspectives and views, and they are competing, and you can see that sometimes in the minutes of the meetings. You'll have multiple different central bank governors, they competing opinions. But I think that the trend is absolutely to the downside for rates. And I don't think that means money printer gets turned back on at any substantial rate. I think that, money printer go burr is what they say. I do think you'll probably see more cooperation over the next few years, 4 or 5 years, between the Fed and the Treasury than we've seen in the past couple of years. That'll have more to do with the federal government figuring out how to properly refinance the debt, assuming the economy grows at the pace they're projecting, because that'll give them an opportunity to kind of hit the reset.
Well, I think you will have different parts of the economy growing than have grown in the last 5 to 10 years, because you have this new paradigm shift with AI, and we could talk about this at some point on a different show, I guess. But this whole idea of the software industry being kind of in the crosshairs of future growth, future development. To a certain extent, it's not all software companies, but it's a lot of them out there that have really had stellar, like a decade of really huge growth, a lot of investment dollars running into there, and now they're kind of at a crosswind, so to speak. They're kind of headed into the wind, and the AI stuff is going to be very disruptive there in that particular sector of the economy, in that particular industry. And in other industries, it will be more of a tailwind. It'll increase productivity, like you were saying, assuming we can get the compute power to use it for long times and not get locked out of it. But it's an interesting thing to watch.
Yeah, I think so. So what do we have going on next week?
Well, next week we have a pretty consequential week on the calendar. 2 things in particular are worth circling. We have Powell's second to last press conference, and obviously they're widely expected to kind of hold still hold steady on those rates. And then we'll see how he characterizes inflation and the growth outlook, considering everything that's happened over these past few weeks.
Yeah, so we'll be listening for that. I think it'll be very interesting to see how they start prepping the collective framework of the Fed as the leadership change is on tap. I think it'll be pretty smooth and seamless, I predict, which kind of is opposite of what you would, again, think from some of the headline that you would read. Definitely a signal to watch for is how he kind of puts his stamp on the rate, on the dot plot and the rate path forward. That'd be very interesting to look. And he'll probably, I think again, legacy and the credibility of the institution is going to weigh very heavily. And I predict probably a smooth transition and a smooth handoff as it pertains to the trajectory of where Warsh wants to go. So I think that Powell will probably be much more dovish than he has been in previous press conferences.
Maybe. You still got the DOJ kind of lawsuit hanging over their head. Did they get rid of that? I was going to say they should drop that.
Yes.
They dropped it?
Yes.
Okay, great. So that changes the paradigm a little bit even more, because now, we'll see what Powell actually decides to do, but he may just decide to jump ship altogether. And then they would have, the freedom to do things they want to do, I guess.
Yeah. But no, I think so. But here's something that really ties into all of this. Your interest rate on your savings account is going to go down. Your interest rate on your emergency fund is going to go down. We're now exiting that comfortable.
We should just move into the planning room, because you're covering what we're going to talk about.
I told you specifically. I didn't want to see it because I'm bad about just jumping in. It gets in my subconscious. But now I'm getting ahead of myself. Let's just look at next week on something else that's going to be worth watching. Okay, if you're really into this and looking at the inner workings of your portfolio, major tech earnings are next week. So we have Microsoft, Apple, Meta, Amazon all reporting. In this quarter, the headline numbers matter less than what they actually say about AI CapEx, capital expenditures, how much money they're going to spend. I'm telling you, it is incredible. I believe just those four companies are responsible for over $500 billion with a T dollars of spending this calendar year.
Yeah,
it is incredible.
So the market is continuing to price that enormous amount of investment. So it'll be interesting to see if they confirm that spending is on track in these earnings calls. We'll wait to hear, or maybe it's an acceleration. We'll kind of see. It's going to confirm the AI growth thesis for us a little bit, at least in the short term. If anybody signals caution or is kind of pulling back on spending, that's a whole different conversation to have.
Yep. Absolutely. So yeah, we got those two big things to watch. You got the Fed meeting coming up. It's going to be very interesting to digest and get a feel for how this transition is going to occur. And then big tech earnings. And so we'll absolutely have the full breakdown of all of those for you coming up soon. Now my favorite part. Now we're here, the planning room.
Now you can get into it. Yeah. We will kind of talk about separating the signal from the noise for investors about the Fed meeting and how to think about that. So you can take it from here.
Yes. So as we have stated before, if you're new to the investing world, or maybe because you've been just knocking it out of the park at work and enjoying life and you don't really care too much, but now maybe you do because you're like, hey, I got to start paying attention to my finances. I'm getting older, not younger. I've got some important things I want to do. Let's just do a little refresher course. The Federal Reserve is the central bank of the United States, and its primary job is to manage monetary policy. They are one of the biggest ways that the money supply expands or contracts. And they do that through managing the cost of borrowing money by setting short-term interest rates, also called the federal funds rate. And it's the interest rate at which banks lend money to each other in short periods of time, such as overnight. So when the Fed raises rates, borrowing gets more expensive across the whole economy. When it cuts, borrowing gets cheaper. So why does that matter for the average everyday person?
Well, the rate that you were just describing is the foundation for everything. Your mortgage is built on it, your car loan, your credit card rates, yield on your savings accounts, high yield savings accounts, all those are connected directly or indirectly to the rate that the Federal Reserve sets. So when the Federal Reserve makes a move, it sends a ripple through the economy, through the financial product economy at least, that you interact with.
Yeah, so if you have credit cards, your rates will go up. Car loan, you buy a new car, rates go up. If you have adjustable rate mortgage, your mortgage goes up. Quick question, call back to 30 minutes ago. What happens when people have to spend more money on interest servicing their debt than they did the month before? Do they have more money to spend on other things or less?
I believe the answer you're looking for is less.
It is less. So there was some interesting academic work done during the last rate hike cycle. I think it's really too early to know if this is correct or not, but it was very interesting. And it approaches whether or not the raising or lowering of interest rates does in fact control inflation. Because now that we have so much debt in the developed world and so much consumer debt, the argument, is really that the effect of raising rates itself will make things cost more money, which actually can work against the goal of trying to get inflation down. It's just very interesting. Again, I think it's too early to tell, and this was not like a widely accepted theory, but it was done very well, and it made some very interesting points. But yes, if you have, just look at it from the perspective that interest rates go up, your credit card, all these other things are more expensive, their angle on it is, well, you have less money to buy other things, so it does kind of control inflation, similar to increases in taxes or increases in baseline commodity needs that you really can't just easily toggle on and off. But it matters for your investments as well, because when rates rise, bonds that have already been issued become less attractive. Their prices fall. We saw this during 2022 and 2023. We saw how individuals that held way too many bonds in their portfolio, had a 20 to 30% drawdown that they thought was like impossible to happen. And it's not impossible. That's why you have to pay very close attention to the type of debt that you're holding. It's
also an interesting conversational point with, interactions that we sometimes have with clients or investors really that may be thinking there's going to be a catalyst in the market that makes the market go down, for whatever catalyst that is. An election you think goes the wrong way, or whatever it is that you think is going to happen in the market's going to be in turmoil and you need to go somewhere. So the historic way to think about that is just go to bonds. Like if the market's going to get pummeled, which I think it is, in that moment or whatever, go to bonds. That's safety. Go to flight to safety or whatever is what you always hear. In 2022, it was not the case. I mean, you wanted to really be in short-term T-bills and cash mostly for most of the year, actually, in 2022. You didn't want to be in bonds at all. And so it's very important to know the difference between, like, if you're actually going to safety, if you think the market is going to be in turmoil, or if it's just like you're out of the, what's the saying, out of the frying pan into the fire type situation. But we haven't seen that for a very long time. When's the last time that happened where the bond market was like at parity? It was like a 1-to-1 parity with equities.
Correlation of one for that long of a period of time. It was quite a while. And that was definitely eye-opening. And that's why, the markets pay close attention to the movement of rates. Not the decision, but the language, the tone, the press conference, and every word really gets looked at. So how do we think about the Fed meetings as an investor, especially if you're, let's say, a new or an established investor, kind of wherever you're at in your financial plan? We can look at kind of maybe go against the conventional, wisdom. The media is going to spend a lot of time because they have to have news stories. The financial media has to have something to talk about. So they're going to put a lot of energy on the Fed, and then that's going to make a lot of people read a lot about the Fed. But we do know that, you should probably focus more on things that actually determine long-term outcomes and not so much on, what happens. But, that's really where it's good to have a professional that you're working with, because you can delegate that responsibility of knowing how to construct the portfolio, and you can delegate, how that portfolio is sensitive or not sensitive to interest rate movements. And then you yourself don't have to worry about it. What you have to be worried about is, okay, I know that I'm going to retire. I want to retire early at 57. And I know I need to do this, 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 and this. I've already spoke with my financial advisor. Everything is set and ready to go. And then you can focus on executing what you can control, and you can delegate the worry to somebody else who knows what they're doing, and not have to really, care too much, I guess.
You're not necessarily delegating the worry. You still hold on to the worry, but I would argue that the more, we do absolutely portfolio allocation, we diversify, all that kind of stuff. That's a very important part of our job. But I would argue a more important part of our job is picking up the phone when our clients call and kind of talking them off the ledge. Like, you have to have somebody to talk to. If you can't just keep it internally inside, like your fears and your concerns, if you don't have somebody to pick up the phone and call and talk through that with, and somebody who's going to understand where you're coming from, and maybe not necessarily, maybe validate some of it, maybe validate the concern, but also kind of remind you of your long-term commitment to investing and the fact that this is retirement. Look, if you're a long-term investor with a 10, 15-year, 20-year, 30-year time frame, you've got a diversified portfolio, you're invested well according to your risk tolerance, these Federal Reserve meetings are not going to mean much for you. There's not a reason for you to change your allocation here. The data is pretty clear that if you try to do that, time it around Federal Reserve meetings, whether buying or selling before that, you don't end up in a good place.
The Fed meetings are never to be looked at as a trading signal. It's a macro signal. So it does tell you something about the environment you're investing in. So it can help increase or decrease confidence, which can really help create very wonderful and potentially fruitful conversations with your financial advisor. So it provides a useful context, but it absolutely should not trigger portfolio changes, asterisk, unless your financial plan is already calling for it. So if it creates if the situation in the context of any Fed meetings or Fed actions are already underscoring your motivation to do something in your financial plan, and the conversations with your advisor is already calling for it, then it could be, time to be more aggressive, time to be more conservative, right? Depending on your particular situation.
Yeah, I mean, that's a good point. There are some times where maybe it does provide a conversation point for you to talk with an advisor or a financial professional about it. A decision that might prompt a conversation, let's say interest rates rising or lowering, and what that effect has on your short-term cash. If you're holding cash or a lot of T-bills or something like that, if that rate environment directly affects the things that you're holding, that might be a conversation you want to have. If you're in the market for a mortgage or a refinance, those expectations matter for your timing. If you're holding long bonds and rates rise meaningfully, that's a real portfolio impact. So there are some conversations that you want to have, but by and large, it's more about positioning rather than like panic.
Yeah. Yeah, the right posture for most investors when there's Fed meetings and headlines around Fed meetings is to really pay attention to the underlying signal, try to understand what it means for your investing environment based on your time frame, and then ask yourself, whether anything about my specific plan has changed. And 9 times out of 10, the answer is going to be no, but in the off chance that there's a yes, that's where you reach out. You go to momentumwealth.us if you don't have an advisor, and you talk with somebody and have that conversation so you can figure out what the right strategy and the right plan is for you.
Yeah, I think that's fair. That it's, if you have any kind of concern, if it's making you anxious at all, if you're lying awake at night waiting to hear what the Federal Reserve does, that may be a signal worth paying attention to. Maybe you need to reach out to somebody and have that conversation.
Yeah,
that could be prudent.
If you're feeling anxious, yeah, absolutely. That means that your plan may not be on solid ground, and it can use some changes. And there's nothing wrong with that. So pay attention to that, but then also try to know the difference of just, being anxious based on what's being fed to you in the consumption of social media and headline news and financial media in particular. Be aware of that and try to be able to tell the difference between, I thought I was going to retire at 62, but the closer I get, it's like 58, I'm out. That now you start saying, okay, well, are my worries concerned? Because now my time frame has shifted. Need to have that conversation and see, what do we need to do with the portfolio? What type of strategy do we need? What type of income are we going to be getting? What are our income sources? That can really bring about some wonderful, constructive, meaningful changes to your financial plan. So it is a balancing act, but just always work with a professional that takes the stress, removes the noise, keeps you focused, keeps you on track, and has a very, very long-term perspective of the market. If you're having a conversation with your financial advisor and they're making you more worried than you were when you walked in, it's time to get a second opinion. It's time to get a second opinion because, we've been doing this for a very long time. And, we have a very grounded perspective on what works and what doesn't. And nothing really is going to change that. No headline is going to change that. Because again, we're grounded, we're focused, we know exactly what we do, and we have seen the material benefit in our clients' portfolios and in their success and quality of life and retirement, that we have a high degree of confidence to be able to execute that for those that may need a second opinion. I know we're running a little bit longer than usual.
Yeah, I think our camera just died too. So
which camera?
That'd be interesting.
The one with both of us.
Yeah, I'm going to get up and turn it on. Hold on 1 second.
Okay. Should I do an infomercial? Yeah. We could put some background music. For just 4 easy payments of $29.99.
Well, the card is full. Oh, well, these things do happen. The card is full. We will bounce out. We'll just do it on one shots, I guess.
Yeah, that's fine. 4 consecutive positive weeks, 2 consecutive all-time highs. Earnings season is off to a solid start. The scoreboard does, in fact, look beautiful.
Yeah. Well, we will be back here next week to talk about all of the fun stuff with the Federal Reserve and all the fun stuff with the earnings. That has been Good Returns. Thanks for spending some time with us this week. Good conversation, useful information, and we hope it leads to good outcomes for all of you.
Yeah, absolutely.
Subscribe if you haven't. Share with somebody who you think might find value in it, and we will see you back here next week, hopefully with all 3 cameras working. So
have a safe, enjoyable weekend, and we'll see you soon.